Hi there, welcome to Kneppy Invest. It's been an amazing few weeks on the market, hasn't it? A beautiful rally in the Australian equity markets. In fact, most international markets, we've seen a really nice rally. In fact, the XGO has gone from 6,760 all the way up to 7,442. So that's a greater than a 10% increase in less than 2 months. And this exuberance we are seeing in the market right now has actually accelerated over the past few weeks. So I want to explore why the market is feeling really exuberant right now in this particular week that was video, just because of the amazing markets we've seen. And to be honest with you, I've loved it because my portfolio has loved it. And if my portfolio loves something, I love it. I think my portfolio overall has increased by about $25,000, which is about 5 or so percent. Now, another question I have, as I've seen this and witnessed every single day, it seems like this rally in the stock market, not only in Australia but also overseas, is whether the market is getting a little bit too ahead of itself. Is the market too excited right now? And in fact, if you do look at the XGO, we're moving into a resistance zone. So anything above about 7,500 in the past, or anytime the XGO gets about 7,500 over the last 3 years, we do see it pull back. Not only that, if you do look at this particular about 2 year history of the XGO, it goes back to December 2021. We have seen similar rallies like this in the past. We saw one in January of this year. In fact, the XGO rallied from 6,880 all the way up to 7,560. And that rally failed fairly dismally during February and into March. So whether this is the bull market, I don't think is the right way to picture it because, and that's how some experts are saying it, this is a start or a continuation of a bull market. I don't think that's the right way to think about this market right now. I just think this is a short-term exuberant part of the market, but maybe I'm wrong. Oh, we all wrong sometimes. And one of the most important things as an investor, even as a human being, is to challenge our biases. In fact, it's one of the most important things to do. And the problem a lot of people have is they always look for information that confirms their bias. Now, I do have to be careful about that because I am going to show you an article I found which might confirm some of my particular biases. Now, what are some of my biases I have in regards to where the market is right now and where it might be heading? Now, the market believes that falling interest rates is really good. I think differently. I think and believe that falling interest rates are not necessarily good for the market. And history shows that in the past, when on occasion the central banks of the world think we have to lower interest rates, they are lowering interest rates for a reason because the economy is struggling. Potentially, even the economy is in a recession. And to stimulate spending, they decrease interest rates. And a lot of times, when they want to stimulate spending by lowering interest rates, we are in a recession. And time again, when interest rates fall, as we are in a recession, the market falls at the same time. So just because the market is exuberant right now because of the potential decrease in interest rates over the next year, particularly in America, it is not necessarily a good thing. So that is one of my biases. I want to challenge that eventually. A second of one of my biases is I do fear that the Fed dropping interest rates too quickly could really fuel another round of inflation, just like the 1970s. In fact, it's one of my biggest fears right now, particularly with some of the information we are getting in regards to how many interest rate cuts the Fed will do in 2024. Upwards of 5. I've actually heard upwards of 8 interest rate cuts. And if they do 8 interest rate cuts, there is potential. We're going to see another round of pretty bad inflation, not only in the United States, but also in the world. And the other bias I have revolves around the importance of labor markets. In fact, I believe that labor markets are the key right now. And my particular bias is that I think we are heading for a period. In fact, I'd probably even say that this time is different, possibly, because we're headed for a period of time where the problem isn't not enough jobs for all the people who want it. It's not enough people for all the jobs out there. And I'm going to show you two articles. One from, I think it's the Bureau, what is it? It's from the Bureau of Labour Statistics in regards to the labour market in the United States. I'm also going to look at an AFR article in regards to the labour market in Australia. And some of these articles are also confirming my biases in regards to what I think is happening right now in labour markets in Western worlds. There's just not enough people for all the jobs out there. And this could be our saving grace when it comes to us heading into a recession, because if we don't see a spike in unemployment, then more than likely we're going to have no trouble. It's going to be one of those soft landings or no landing at all. Definitely not a hard landing. So let's have a look at what's been causing this exuberance in the market. And it all comes back to this particular article. Well, not this article itself. This article did not fuel the exuberance, but just look at the title. Powell signals Fed ready to cut rates next year. The market loves the very fact that the Fed has already said during the last, either last week or last 2 weeks, that more than likely they were going to cut rates in 2024. So let's have a look at some of the stuff that's said in this article from Matthew Cranston, who is the United States correspondent, released this particular article December 14, 2023. So the central bank in the United States, or the Fed, is keeping interest rates unchanged at 5.25 to 5.5% for a third straight time. So it's not that causes excitement in the market. It's what the Fed chair said. Jerome Powell said that cutting rates had now come into view. So cutting rates had now come into view as inflation continues to fall towards a bank's 2% target. He also said it was still possible that the US economy could enter a recession. And I think the equity markets are missing that point, which I'll get to in a second. He also said that I think there's also a probability that there will be a recession in the next year. And it's a meaningful probability. I don't think the market is actually listening to the whole story here, which again, I think it's important. He also said it's far too early to declare victory, but this is what got the market excited. The Fed's policymakers indicated they expect to make 0.25 percentage point cuts to their benchmark interest rate next year, fewer than the 5 envisioned by financial markets. Again, I think the financial markets are getting a little bit too excited. But one more, and this is why the markets rally, but one more than the central bank expected it would make in its September forecast. The Fed's forecast showed that policymakers expect to cut their benchmark rate to 4.6% by the end of 2024. Powell said it's not likely that we'll hike again, although you can never take that possibility off the table. We know economists, we know reserve banks or central banks around the world are mistaken all the time. I won't go into the rest of this particular article. PCE price index revised down. Anyway, so this is what's causing the exuberance in the market right now. And you might say, well, that's fair enough, because when interest rates were rising, that really saw troubled times in the equity market. So you might think there is a link between interest rates and the equity markets. Not always the case. Again, when interest rates fall, it's a symptom of a struggling economy or even economy in a recession. And typically when economies are in a recession, you see equity markets fall quite significantly. Now onto that particular article that I found. I don't know how I found this article, but it really does confirm some of my biases. This is from Saxo B Invested. I look at previous Fed rate cuts and what it means for equity. So I think I was just looking for the relationship between Fed rate cuts and what happens on the stock market. And this was a really interesting reading. It was released on the 7th of September of this year, written by Peter Garney, who is the head of equity strategy. So I'm going to actually say some of these maybe some of these paragraphs word for word, although I don't think this was not fact checked. It wasn't spell checked or even grammar checked. I'm not sure if they have a proofreader or anything like that, because some of the reading is a bit hard. Anyway, so the summary: the market is increasing its confidence that the Fed will cut its policy rate at the March meeting, starting a rate cut cycle. We take a look at previous initial rate cut cycles and how the US equity market responded to it in the first 90 trading days to such a rate cut. We discussed the conflicting signals in the economy between financial conditions that have eased substantially against the easing inflation, setting up a difficult decision for the Fed because which factor should they emphasize in the short run? So hopefully that will become clear in a second. So initial rate cuts are rarely seen as negative. Not only initial rate cuts, but expectations of rate cuts are seen as really positive. That's what the research that they have done here. And I'll just quote this first paragraph. Since 19th of October this year, the market has drastically altered its view on inflation and, more importantly, policy rates set by the Fed and ECB. As the US secured overnight financing rate, or SOFR, which is fairly important moving forward, December 2024 contract is showing the market has moved the 2024 terminal Fed funds rate lower by almost 100 basis points. This repricing has fueled sentiment in equities, delivering one of the strongest months in 20 years in equities. Again, one of the strongest months in 20 years in equities. The SOFR futures forward curve is now pricing in 5 rate cuts by December 2024. Again, 5 rate cuts in the next year, with the Fed rate cut, or the first Fed rate cut, coming in the Fed March meeting, which is on the 20th of March. Now, they go into looking at the last 9 examples or 9 samples of when the Fed initially cut rates and looked at how the S&P 500 performed, and it was fairly bullish. For instance, they say here, right at the end of this next paragraph, the average S&P 500 gain during the 19 trading days after initial Fed rate cut is 5.1%, which is significantly above the normal 3-month S&P return, which is around about 2 to 2.5%. But he also says here somewhere that it's only a sample size of 9, and that's not really possibly scientific significant. Now, history gives us a clue that initial rate cut by the Fed is often interpreted by the market as a natural initial adjustment of policy rates to changing circumstances. But the market is, this is really important part, but the market is rarely coupling the initial rate hike with an incoming recession. So right now, it doesn't look like the market is thinking there's going to be a recession, and there is actually facts to back that up. If that was the case, history would this is where there's no one reading, because it says if that was the case, history would a more clear downward direction. So again, they need someone to proofread these articles. So if that was the case, history would have a more clear downward direction in equities post an initial rate hike. This is also the likely reason why equities have rallied since mid-October. So the recent low we saw was towards the end of October. The equity market sees a current price in rate cuts as a natural adjustment to lower inflation and not a sign of a recession. That could be a mistake by the market. Maybe it's a sign of a recession. Should, and this is another very important part, should SOFR futures suddenly rally a lot higher from here, then it would be a sign that traders are seeing a recession coming, and then the interpretation by equities will flip on a dime. So there is a potential that if we see the probabilities of recession coming increased by the equity markets, then there is a potential we might see the equities move significantly down. This is another important paragraph, very important paragraphs here, in my opinion. So again, but this is confirming some of my biases. Another striking difference in the market is the median recession probability by economists tracking the US economy is 50%. And I have heard that number a few times now, which is a huge divergence from equity markets, which are closer to all-time highs. The Dow Jones is an all-time high, if I remember correctly, and thus seemingly less than a 10% chance of a recession. And I have heard quite a few experts in equities say there's very little chance of recession now. It's a bull market. We should all be buying because interest rates are going to fall. It's all good times. And I think that is a possibility. In fact, I'd probably lean more towards a 10% than a 50%. And the main reason is because of one of my other biases, and that is the labor market. And I think this time is possibly different. So all I want to talk about when it comes to, there go nice little graphs here. Financial conditions versus inflation. Shall we talk about this? Oh, this actually highlights one of my other biases. There's the third paragraph in this particular section, and that's all I'll talk about. So, in fact, I'll talk about the last line here. If the Fed followed their own methodology, they would sit tight for longer, avoiding a repeat of the 1970s where they cut the interest rates too quickly. This is one of my biggest fears right now, that the Fed is going to cut interest rates way too quickly. And I believe 5 interest rate cuts in 1 year is way too quickly. And I am fearing that we're going to see another round of inflation because of that. So that, in my opinion, is one of the biggest threats we have moving forward as economies. Now let's have a look at at the labour market, focusing on Australian and the United States labour market, looking at 2 articles. The first one is from the AFR again, and for some reason, both of these AFR articles were free for me. I'm not a subscriber to AFR. But this was released on December 14, looking at the job or the labour market. So jobless rate hits not 3.9%, which is the highest we have seen for 18 months. But labour market remains strong. A sharp increase in the number of foreign workers is helping labour-starved employers fill many vacant jobs. Again, one of the biggest threats we're going to have in the future is not having enough people for the jobs. And in my opinion, that's why automation is vitally important. And one of the reasons we won't have enough people for the jobs is because of really low birth rates in Western worlds over the past few decades. Not only Australia, United States, Europe, Japan, and that is actually happening at non-Western world countries. They track birth rates in Mexico and Iran, and they have dropped from over 6 20 years ago to less than 2.1. And for anyone who knows, 2.1 is the key number when it comes to birth rates. So even though the job rates actually increased a little bit, and the key focus moving forward when it comes to recession is unemployment. It's one of the main things we look at when it comes to unemployment, when it comes to recession. In fact, if we see the unemployment rate increase, and quite a nice increase. When I say nice, I mean a really good, strong increase in unemployment. There is potential that they will call recession in the United States. But I'll talk about that more when we look at the next article. But even though unemployment rates have increased slightly, the labour market in Australia remains robust because there have been an increase in jobs in the past month. In fact, they were surprised by the amount of jobs that had increased. Employment increased by a stronger than expected 61,500 people. They only expected a modest growth of 10,500 people. So the amount of jobs significantly exceeded expectations. So again, a really robust labour market in Australia right now. And I think this will stop us from falling into recession. Probably. That's what I'm going to say. Probably, because I believe this time is different because of the labour market, because of the dearth of people going from high school, university into jobs because of lower birth rates over the past 20 or so years. Now let's have a look at the United States. And this is again from the Bureau of Labour Statistics. And this is also pointing to a really robust, healthy labour market in that particular country. Total non-farm payroll employment increased by 199,000 in November, and the unemployment rate edged down to 3.7%. And this is a 40-page article. I'm not going to go through this whole article, but again, the labour market in America right now is quite robust. We're not seeing that increase in unemployment, which would cause a little bit of fear in policymakers around the world that we're heading towards a recession. So maybe, just maybe, that this exuberance in the market is well founded because we're not heading towards a recession. So there is that possibility. But on the other side, is the market getting too excited? Because a lot of times when central banks decrease interest rates, and 5 interest rates in 1 year is a fairly significant increase in interest rates, typically or usually it's because of sluggish economies. So I have no idea which way we're going to move forward. And I think it's all the labour market is the key at this point in time. Now, I was going to talk about some interesting announcements from companies over the past week. So Pact Group, Smart Group, Macmillan Shakespeare, Bubs, Parenti, TG Metals or something, Parabellum Sigma, which I actually did a standalone video on. Volpara being taken over, looks like. Vita Life Sciences, a company released a profit guidance or trading update, and I should do a standalone video on that company. Link Administration, Adbury, and IDP Education, but I think I've already talked long enough. So if you want any questions about any company I just mentioned there, just leave those in the comment section of the video. But otherwise, that's it for this video. And the last thing I should just mention is I'm not a financial advisor. In fact, I am an economist. For those who don't know, I am actually an economist. I do have an economics degree, also have a meteorology degree. So technically, I am an economist, and I do like macroeconomics, probably more than microeconomics. But anyway, I am not a financial advisor, but I am an economist. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.